Right now, we're watching a growing divergence in the US economy. On paper, growth looks strong, consumer spending has remained resilient, and business investment, especially in AI and large-scale infrastructure, has continued to expand. But that strength is narrow, and it hasn't translated into broad job gains. Labor market signals are mixed. Overall growth is holding up, but payroll growth has slowed as hiring demand cools. At the same time, the amount of available workers or our labor supply has weakened. And this split of strong growth but weak hiring is what's shaping our economy right now. And it's exactly the setup that the Federal Reserve is responding to. At the most recent meeting, the Federal Reserve decided to keep interest rates unchanged, holding them in the 3.5% to 3.75% range, or what policymakers describe as the upper end of neutral. Basically, rates are tight enough to keep inflation moving lower, but not so tight that they immediately trigger layoffs or a sharp slowdown. That's why the Fed isn't rushing to move. They're waiting to see which side of the economy becomes the bigger risk. On the inflation side, the picture has improved, but it's not fully resolved. Inflation has eased significantly from 2022, but it still sits above the Fed's 2% target. Where inflation remains elevated is in the goods sector of our economy, where the Fed says much of it is tied to tariffs and supply chain adjustments. At the same time, inflation for services, which is more closely tied to wages and domestic demand, has continued to ease. If goods inflation proves temporary and services inflation keeps easing, the Fed can have more room to cut without reigniting inflation. But that's only one side of the equation. The other risk is the labor market, which appears to be stabilizing but at a much softer level than earlier in this cycle. It's not collapsing, but it's no longer tight. Hiring has slowed, job gains remain low, and unemployment has begun to drift higher. And right now, the Fed is managing these two pressures at once. Inflation that hasn't fully returned to its target, and a labor market that's clearly losing momentum. That creates an economy where growth can be sustained, but it's not evenly distributed, and helps explain why conditions are differing so sharply between households. For households that rely primarily on wages, slower hiring reduces opportunities to find better jobs. Weaker job growth limits pressure to increase wages, and higher borrowing costs still weigh on rent, credit, and everyday expenses. When GDP and labor markets start telling different stories, policymakers tend to trust the labor data more, as output can be supported by productivity and investments. But job trends are often a clearer signal of underlying momentum, and that's why the Federal Reserve can justify holding rates steady right now. Growth is still coming from spending and investment. Inflation is cooling, especially in services, and the labor market, while softer, is not collapsing. So policy stays in place, not because conditions are ideal, but because different parts of our economy are signaling different things. So whenever new data comes in, the key question is, where is it coming from? As long as growth is being carried from outside the labor market, the economy can look stable on paper, even as job conditions continue to slow. That's the divergence we're all watching, and it's what the Federal Reserve is responding to, and that's what's shaping economic conditions right now. Thank you so much for watching. If you liked the video, hit the subscribe button, and I'll see y'all all next time.